Hello to you all, ladies and gentlemen. We're going to get started in just a moment. Okay, so there's a fair bit to talk about this evening. There's been quite a bit going on. Interesting times in the markets, as always, and quite a few developments here at Investor Unity as well, in terms of the products and services and refinements and improvements and developments and evolutions and all these other good things that are always going on in the background. And sorry for the problems with the website over the last couple of days. It was unexpected. Companies don't manage their own websites. Well, they do manage their own websites, but they have third-party hosts to handle these things and make sure that the site is fast and it's available from around the world and all of these very back-end technical type of things. And our host just decided somewhat out of the blue on Sunday to do some pretty serious maintenance, so it did affect the availability of the site. So that's why we're running today's session on a Wednesday instead of a typical Monday. But we'll talk about a couple of schedule updates as well. And I just want to remind everyone that the trading services that we run, especially for the managed services, they run on completely separate systems. They're not even with the same company. So anytime you experience any minor bugs or slowdowns on the site or whatever it is, don't let it cause any concern in respect to the trading services. Don't worry about that. So in terms of the markets, fun and games as always. And it looks like we've been able to get quite a few of the services that we've been developing in the back end, while markets have been somewhat less opportune than we would have liked them to be, of course, or that everyone would have liked them to be. Get the products and services sort of developed at a good time, in good coincidence with the markets coming into a more opportune stage, or perhaps thereabouts. So we'll talk about some of the things going on there tonight as well. And let me just bring up my market notes here. All right, so as has been the case for some time, it's a highly politically driven scene, highly news-driven environment that we're in the markets, globally speaking. And when we say globally, of course, it's all very much largely driven by what goes on in the US. Nonetheless, we do have some very anomalous events going on that have been sort of drawn out for a few years now. Jumping across to the S&P 500, the US benchmark index, that is, and drawn out really since the start of 2018. As you can see here, we've got this large broadening volatile formation going on here. And some of the things that are just somewhat more anomalous with the recent environment is that currency markets and equity markets are all sort of tied and underpinned by this central dominant theme, very politically driven once again. Basically, you've got the US dollar being the driver of pretty much everything in the world right now, and that the one thing that everybody is looking at to really wait to see what the next medium to longer term outlook of the global economy is going to be. And so you've got that happening in conjunction with anomalous politicians themselves being our celebrity president there, and his tweeting habits, of course, moving things around, and the fact that he's putting a lot of pressure on the US Federal Reserve to try to keep a positive, a business positive, that is, financial climate, monetary policy environment, banking environment. Okay, so in other words, he wants the US dollar to continue to be fairly cheap, and he wants interest rates to continue to be very low, and he wants financial stimuli to continue essentially forever, which is not, he's not unique in that that desire or motivation in any sense of the world. It's very much echoed by the bankers and powers that be around the world to varying degrees. It's actually one of the few things they can all sort of agree on behind the surface or below the surface of the every other political debate and scandal and drama and other kinds of noise and nonsense. So what's been unique for a few years now is the fact that equity markets and currency markets are more heavily correlated or more interdependent upon each other, and that in many ways the currency market is taking much more of a direction from the equities markets, whereas typically it's the other way around. If anything, they don't have a strong degree of correlation historically, more broadly speaking, but if anything, it's typically the currencies that influence the stock markets. Of more recent years, it's that balance has been somewhat shifted back towards the equities markets. And so, again, on the political front, we've got to consider the fact that we have an election coming up at the end of next year. The Donald Trump's opponents, all but outright hate him, and they're pretty much going to be doing whatever they can to get him out, whether that's tax evasion or tax evasion claims or impeachment, some other sort of impeachment impeachment case attempt, whatever the case may be. So we've got a lot of things going on, and it's very much in Donald Trump's political interest, of course, to keep the equity markets propped up. In fact, a lot of political analysts will tell you that if the economy doesn't continue to be strong coming into election time in November 2020, then there's quite a strong chance that he's going to lose. Other people will tell you different, but at the very least you can rest assured that that's on his mind. And so with that, when we look at the kind of price action that we see and the much broader picture of global debt and massively overinflated equity evaluations, none of these things exist independently of each other. The fact that it's all going on at the same time is not a coincidence. It's just part of the long-term cycles that global economies go through in terms of their expansion and contraction periods. And what happens is, after a long period of expansion, everybody starts to get a bit anxious, especially when there are so many fundamental concerns in play, and everybody's really looking for the next sign that the party is over and that things are about to get trickier, get more dramatic, and just get a lot more volatile and choppy. So the position that we've held for some time is being played out with a fair degree of accuracy, prolonged as it may be, and that is that we're essentially just in for a lot more volatility coming up over the next, I'd say, a minimum of 6 months, unless there's some sort of very clear development on the election front and or the monetary policy front. And we haven't even spoken about global economic conflict in China and that sort of thing. That all factors in, of course, and is all part of the same mix. And there's just a lot of ways in which the I don't want to sound extreme or overly dramatic by calling it a house of cards, but the balancing act that's being upheld for some time, there's just a lot of ways in which it could really start to crumble pretty quickly. So we've just got to be careful of that, because if something does happen, if there is some catalytic event that is more impactful than people give it credit for, let's say, then it could have a very serious knock-on effect. And naturally, we're going to feel that in Australia, and we're going to feel that all over the world. Now, in saying that, just to contradict myself, well, not so much, not really, because you've got to be able to maintain different perspectives simultaneously in this business, in this game, and you have to basically try to weigh up the evidence and look to see what's going to happen over the short to medium term in conjunction with the longer term, and then you weigh up the relative risk and reward, and so you end up taking a position. You end up deciding on a best course of action. That's what it's really all about. But on a shorter term, which in the broader context of things is really more of a medium to longer term development, we still have this upward formation here that given the developments over the last few days with positivity on the trade talk front between President Xi and China, so President Xi and President Trump, that is, given these developments and the reaction that we've seen here, and the fact that this more recent leg is part of a higher uptrending formation, there is an ever increasing, very recently speaking, there is an increased possibility that we are looking for, that we could be in store for an extended run to the upside. So you've always got to keep these things in mind, and certainty, operating under an illusion of certainty is a very big danger in financial markets, because nothing is ever certain ever. That's the only thing that's consistent, is at least some degree of uncertainty. But what we see here is this coming up to a point where we're going to come into this ascending triangle formation here, this ascending wedge, I should say. Okay, so now I still lean to the downside. I think there's a lot of space to fill down here, but it wouldn't surprise me one bit if there was some positive news that was come out, or even sort of forced out, you might say, that did make things pop up to the upside. I still don't see there's much upside potential in the short to medium term, but when things do start to come to a bit of a head, as they are clearly at the moment, then that's when you have a much higher potential for volatility. Okay, so we could see some real volatility coming into this formation that we see coming up here. Okay, so the other thing going on at the moment is the Brexit scenario, and so Brexit is again just looking at the anomalous kind of events that have been happening for a few years now. Brexit is all part of that overall picture. It's not separate from it in any way, even though it is unique in many ways. It's all just part of this global shift that occurs, and that is both a cause and an effect of the monetary or economic shifts that occur after long periods of expansion or contraction, vice versa. But we'll take a look at the pound in a second, and before that, let's take a quick look at the pound actually. So this is the Great British Pound versus Australian Dollar, GBP AUD, and that's had a good little run over the last few weeks with a strong pop up over the last few days, driven by some real GBP optimism, all again based around such a highly politically driven event such as a catalyst, I should say, as Brexit. So this one is looking good on the medium to longer term, and the basic idea behind what's been going on with this is that all of these Brexit fears and concerns, and the European economy collapsing as an effect of Brexit, and the UK economy collapsing and going back into the dark ages, and all this other kind of drama and nonsense that gets thrown around that the media loves to capitalise upon and make billions of dollars from. It's never really ever as bad as it seems, and people are always going to put money first, at least to some very strong degree, and so they're going to make a deal to make sure that they can keep buying and selling cars and holidays and banking services and financial services. They're just going to figure it out to the best way possible, because if they don't, then they're not going to get elected, and everything's going to be turned into an even bigger mess for them. So I did mention this actually back at a couple of years ago at least, and it looks like that's starting to become the case. They're starting to figure something out, and moreover, people are starting to realise, or the market is starting to realise, that the concerns were never fully justified in the first place. And so we'd look for this 2 mark here, this £2 mark here as a target, especially if this consolidation, this broad expanding consolidation phase here, does continue to break to the upside. On the short term, it wouldn't be surprised if we do need a little bit more consolidation around this area here. But overall, the Australian dollar is essentially looking quite weak, as we can see here. Still very much trending down, and even on a short-term basis, this looks like a little bit of a head and shoulders type formation that we see here, in which case we would look to see some fairly extended downside as well. Again, while GBP across the board is really looking quite strong. Okay, so we're looking GBP versus USD. There, the euro versus pound. You can see that the euro is weakening against the pound. The euro is looking quite oversold across the board, mind you, and so forth. Great British Pound, Canadian. It's essentially the same picture across the board for the pound. So GBP AUD is one that we're looking at quite closely. Now, the other story from the macro picture side is crude oil. So there's been some more. There's ongoing tensions in the Middle East, as all of you have heard about, no doubt. It hasn't had much of an effect at all upon oil. In fact, the oil market doesn't seem nervous at all. And when you see conflict going on in the Middle East, there's a lot of people that tend to jump up and down and talk about it escalating or blowing up into the next World War III and Armageddon and all of this sort of stuff. Well, and I have a friend of mine that's like this. Every time there's some skirmish or conflict in the Middle East, he's always talking about how it could turn into this with Russia and this with China and everything else. Well, what you want to do to get a bit of a clear picture of the seriousness is to look at the price of crude oil And if it's not jumping around and bouncing around all over the place, and typically you would expect it to go up, then chances are whatever's going on in the Middle East at the moment doesn't have much of a chance or much of a risk, any kind of significant risk of escalating and turning into something major. Because you can rest assured that the powers that be and the major hedge funds have the best analysts in the world looking at the situation very, very closely. And they're of course, adjusting their own investment and capital flows and risk allocations accordingly. So, not a great deal going on there. We did actually call this one as a bullish trade right about this point, with a higher level target up towards this 65 range there. There was an attack on a Saudi tanker that occurred right about this point here, which very quickly drove it up above this downtrend line that you see here. But it, as you can see here, is that didn't last very long at all. I did mention at the time, right about on this day, in fact, that if the situation with the tankers, it was blamed on Yemen at the time. If the situation with the tankers was resolved fairly quickly, then you could look to see some further downside action, and that's essentially become the case. So from a longer term perspective with crude oil, we are looking to we looked for some further consolidation within this 57 to 50 range here, 50 being a very key psychological barrier, as you can imagine. And if it was to break the 50 level and break this uptrend line that you see here, which isn't a very strong uptrend line, mind you, but it is coming into a strong area of support there through the 45 level. But if we were to see a break of the 50 plus a break of the uptrend line there around that 45 mark, then we would look to see some further continuation to the downside. Very, very tenuous and once again, you always have to keep the political situation taken into account when we look at crude oil, because it's highly sensitive to this, obviously, and it's highly sensitive to unpredictable events taking place. So next, we will talk about volatility as a whole. So if we look at the VIX is actually down quite a bit over the last few days. In fact, it's toward the bottom of its long-term range there. Okay, so the VIX is the volatility index. It's a forward-looking. It's a 30-day forward-looking futures index contract, and it's just used by various market participants around the world to gauge the level of uncertainty and concern that the market has as a whole. So when we see dramas going on around the world, we see the volatility index spike. But as you can see here, right around this 14.12 level here, it's really at its low range that has been essentially maintained outside of the high volatility periods since early 2013. Okay, so this means that we're expecting market calm, and if we were to put this in the context of the global indices, once again, equity indices, it lines up, or it confirms, I shouldn't say confirms with any degree of certainty, but it lends weight to the idea that we're just looking for a little bit more continued optimism for the time being. So this is the US 30. Earlier we were looking at the S&P 500, but the US 30 obviously is painting a very similar picture. So this overall picture that's being painted by the various indices around the world, in terms of the underlying theme and drivers and fundamental conditions, as many people will tell you, there's not a lot of true and non-manipulated economic drivers that are holding this market up. Again, there's huge debt across governments and companies and everyone else, essentially, across the world. And then there's all-time high evaluations on the various equities around the world, particularly the major equities, particularly the headline equities such as the FANG stocks and everything else. So the underlying concern really is how long the market can continue to maintain these kinds of levels and can remain in a perception drives reality type environment. And so going against that, if you are considering looking for shorting opportunities, as we are, as I am, as I have been for some time, you just have to be really careful about how you about the entries you take and the way that you time it, because as the famous saying goes, as many of you are aware, the market can remain irrational for much longer than a person or company, for that matter, can remain solvent. So you've just got to be cautious in looking for reality to come to light, and for reality to take its grip, and for the markets to start behaving in a more rational way. Okay, so it's all driven by crowd psychology, and the crowds can remain irrational and emotion driven for a very long time, as we can see. So on the flip side of that, conversely, you also have to proceed with if you are more optimistic, you have to proceed with cautious optimism as well, because once again, because of the levels that we have at the moment in play, and because of the so many numerous fundamental concerns, and the fact once again that we just have so much space to fill down here, as you would have heard me say in a few of the recent presentations, or the earlier presentations a while ago perhaps. So the market can retrace the US 30, this is the Dow Jones Industrial Average. The market can come down 21% from its highs, from its current levels, without even interrupting or violating its long-term uptrend levels. So the global economy may still be long-term quite healthy. It's just a case of these prices that we're currently trading at not actually reflecting the value of the companies that are pushing the index and pushing the market and driving the engine of the global economy. So that's the US 30, and when we look at this idea of perception versus reality, we can see this painted perhaps most clearly if we look at a comparison between the Russell 3000, which is the top 3,000 companies in the US market, which, as you can see here, paints essentially the exact same picture as the S&P 500 and the US 30, and also the Nasdaq to a slightly lesser degree. Okay, jumping it back across to the Russell now. So the Russell 30 looks like that, but if we were to look at the Russell 2000, we actually see something a little bit different in play. Like so. Okay. So the Russell 2000 the name itself is actually a little bit confusing, but it's actually the bottom 2,000 of the top 3,000. Okay, so it's actually the top of the market, the biggest companies in the US market, excluding the top 1,000. So let's put the two side by side. Okay. So we can see the two tracked, or tend to track along very, very closely, correlated. But if we look at what's happened since sort of start of the second quarter 2019 or thereabouts, we can actually see there's quite a strong degree of divergence there. Historically speaking, this is unusual. So taking this one off, what we can see there is that considering the notion that the Russell 2000, again excluding the top 1000, is excluding a lot of the mega cap stocks like your Googles, your Microsofts, your Amazons, and so on and so on. A lot of the headline stocks, a lot of the stocks, a lot of the household name type stocks, and as such, you can see there's a lot more indecision about the future of the market and the future of these types of companies. Okay, so we did mention this a while back, that the Russell 2000 is on the radar and is something that needs to be not just considered in terms of trading opportunities in and of itself, but also very much as a barometer of the underlying fundamental picture actually starting to come to light and actually really starting to play out, and having, again, looking for that longer term, that broader knock-on effect, so to speak. So I mentioned that we're looking for various opportunities with equities, and that's starting to kick off or get us back into the VIP signal service and the VIP live sessions, which we're going to be running. But I do urge a high degree of caution for anyone who's looking to take advantage of what they perceive happening on the equities market, whatever that may be, whether that's positive or negative, or perhaps a combination of both. I do suggest, particularly for anyone that's looking to go short, perhaps, to focus on trading indices as opposed to individual equities, or at the very least look to try to find individual equities that don't gap, or have that gap to a very small degree. Okay, that's going to be really quite important, because everything is all about looking for positive risk to reward scenarios, and if we do come into this crunch zone here and experience the kind of volatility that's really quite likely, breaking out of that, whether it's to the upside or the downside, either way, there's a high degree of there's a much higher risk potential for there to be a lot higher volatility than usual, and thinner markets, lower liquidity markets than usual, and therefore the kind of price gapping that typically comes with that kind of environment, that kind of development. So what you want is something that's cost effective and that doesn't, so that you can jump in and out as necessary, and something that doesn't ideally gaps to a very small amount, or almost not at all, as the index contracts don't. So the S&P 500 is one. Just bear in mind the value there. There's 3,000, just depending upon which, whether you're trading E-mini futures or whatever it is, or the US 2000 to give you a bit of a different picture, and a lower value contract there at just 1,500 US. Be careful with value contracts, even the S&P 500, because it's going to essentially give you the same development, the same price movement to very small differing degrees, but with a lot more flexibility with your position sizing there, which of course is a crucial thing. Okay, so we're running a bit late on this one. I'm going to go across to some of the other indices. So talking about the China situation, I mentioned a while back that the Chinese market is still looking was in a bullish upward triangle formation. That's continuing to be the case. You just want to look out for this 14270 level, this 14,300 level thereabouts. It's still, even if it fails to breach that key level there of 14,300 as part of this upward ascending triangle formation, doesn't necessarily mean that it's long-term bearish, but it means that it just might need a little bit more time to consolidate within this broader formation that we see in play here. The UK 100 is looking a little bit sickly. So there was some negative economic data that came out for the UK 100, and so that's had a little bit of an effect upon the equities markets. It had a barely noticeable effect on the Great British Pound, by the way, which is of course speaks positively for the Great British Pound outlook. With the UK 100, it does look a lot more bearish, a lot more clearly bearish than the others in this sloping head and shoulders formation that we see in play here. So we might be looking at a target here around this key level of 6,800 or 6,850. 6,800 to 6,900 is the support range here, the near-term support range here on that one. Then we jump across to the ASX. So during the last presentation, just hold on a moment, please. Okay. We did mention in the last presentation that the last focus session that we had, we're looking for some selling to resume at this point here. That occurred, and then with the fundamental developments on the trade talk fronts, positivity, it's just bounced right back up, as you can see here. And I won't go into too much detail with this one just for the sake of time, but what you can really see playing out here, as you may well expect, is you can see a real mixture between the US situation and the China situation. The market is doing its job in a sense of being quite a true combined environment or set of developments taking place in the Australia 200 market there, the Australian market. Generally, again, it's just a case of probably looking for a little bit more upside potential, but the medium to longer term, over the short term that is, with the medium to longer term picture still being quite unclear. Okay, and just remembering that we are at these all-time highs here at 6,840 thereabouts. going all the way back to the pre-GFC levels there. So when we look at the Australian market, we see a lot of other global factors going on, as I mentioned. And one of the key questions everyone really needs to ask themselves is whether or not we have enough steam in the engine, enough fuel in the tank to push us above these significant highs to any meaningful degree, or whether it's more likely that we need to take a little bit of a breather and come back towards these levels within the range, like so. So there's your middle of the range, right about there. And just using fairly simple equidistant channels, like so. You've got your, you can see quite clearly that we're at the top of the longer term range, which coincides with the all-time highs there just before the GFC. So that's the question you have to ask yourself, is where the probabilities lie, whether it's more likely that we need some more room to consolidate within this range before potentially making another attempt, perhaps, or whether it's more likely that we're going to break ahead. And so once you've got a sense of the relative probabilities of either of those two scenarios, then what you can do is you can take a bit of a risk-reward comparison. And so you would look at, let's be pretty generous there. So you just have to ask yourself how much more upside potential there is. Personally, I don't see much greater upside potential outside of some very strong fundamental catalyst that really breathes some new life into the market, or some additional life into the market to continue it over the medium to longer term, perhaps in the form of a strong quantitative easing injection, perhaps. All things have to be considered, all possibilities need to be considered. But in any case, you've got the actual relative risk-reward leaning quite strongly to the downside, even if it's only going to retrace back down to the lower ranges of its channel. Here, you still have about a 1.5 to 1 risk to reward. Okay. That puts it at 1.6, just using those calculations there. And so that's on you're looking at a fairly conservative, bearish scenario. If we were to really breach this, if this long-term upward channel formation was to be broken and breached in any serious way, then of course there's far greater downside potential coming back down towards this 5,000 level here over a period of several months, many months perhaps. But these are the things you really need to consider as we do. Okay. So staying on the Australia theme for now, let's take a look at BHP. So BHP again is at quite a significant level here. We've got a fairly significant range here between this 34 level to the 39 level, 39.50 level there. Now this uptrend line that we see in play here should be taken as really quite significant. I think that if we were to see a break to the downside here with any kind of meaningful momentum, it gives a lot of weight to the negative case, the medium to longer term negative case for BHP, and of course it affects the overall picture as well, being such a instrumental part of the Australian economy. We see something similar in play with Rio, as you can imagine, such highly correlated stocks. Essentially the same situation in play there. We have a more bullish, positive outlook developments when it comes to the banks. The banks are looking a little bit more positive, or they at the very least seem like they don't have as much downside potential. They don't have the potential to quickly lose a lot of their value like some of the other companies do. We see the same thing occurring on ANZ, of course, as you would imagine, perhaps a little bit more clearly with ANZ. So just looking at the evidence and looking at the factors to take into consideration as they're being presented to us at the moment, generally more bullish on the banks, while generally more bearish or negative on a lot of the other sectors, including tech, which we're going to take a look at in a second. We'll jump across to an American bank, Bank of America. These drawings that you see on the chart here have been in place for a long time, by the way. I'm not drawing them just for now. This is the longer term formation that we see in play here. Look for this key range here at 31 to be breached. If so, that gives a lot more upside potential there. Anything on the lower end of the range here, perhaps around the 28 or so level, gives, assuming that you do agree with the longer term trend, direction, momentum, gives quite a good risk to reward ratio, even if only near term highs are targeted. Okay, like so. 2 to 1, so 1.8 to 1 risk to reward, which means that even if you only get 45 to 50% of those correct, you end up doing well over time, as long as you manage your risk effectively. Okay, and don't have anything to say with Goldman Sachs. That's a little bit indecisive, that one, unclear. JP Morgan, as you can see here, very much mirrors or is moving in a very similar way to Bank of America, as we just saw. Again, just look for the way price develops and expands within this expanding range here. But reasonably good upside potential, even on JP Morgan, which is close to upside high, close to or is at all-time highs, if I'm not mistaken. Yeah, of course it is. And the case for the bullish case for this is dependent largely upon this broadening formation that you can see here, which is something of a reverse head and shoulders, as some of you may have already noticed, like so. Okay, jumping across to the US dollar. So the US dollar is the, as I keep stressing, and as many of you will know already, is the one to watch, both fundamentally and technically. For a long time, we've just been with a bit of an aberration there, but for essentially since the structure itself has actually been in place since late September 2017. And so that's the formation that we really want to keep in mind. This clearly defined directional channel, like so, with the fact that we have a key level here of $1 coming up there. So the US dollar index is an indexation. It's a broad-based calculation of the value of the US dollar weighted against a basket of other major global currencies, including the Australian dollar and the Swedish krona and the Great British pound and the euro and the yen. And a lot of fundamental analysts that I respect, because I don't get very deep into the fundamentals, as some of you will know, but some of the fundamental analysts that I respect in this industry, and there aren't many of those, are essentially quite bullish on the dollar, and they actually see the bullishness of the dollar as the final dropping of the shoe that causes a lot of problems in equity markets and so forth around the world. So it really is one that you want to keep an eye on. Again, whether that's the charts or whether you're monitoring the fundamental situation or perhaps a bit of both. But I certainly am. This $1 mark here seems like it will be targeted at some point in the near future, and you certainly want to look to see what happens around that level there. The market is going to be watching this 100 level there really very closely. Okay, so depending on how you do things, you might just want to go and set an alarm or set an alert or whatever it is you do, like so. Now we can see the converse in play if we look at the euro. Naturally, again, essentially the exact same thing in reverse has been happening since 2017, September 2017. The euro, looking at the euro independently, in and of itself, it's really looking quite oversold on a number of fronts, and so we're generally bullish on the euro. We'll just be careful about trading it against the US dollar. There may be better opportunities to trade it against the Japanese yen, for example. So aligning with the broader theme, we can see that the euro is is at the end of a long trend, or is in a long down trend, I should say, but is starting to show signs of being oversold, and that's due for a retracement. One of the factors of which would be that we're at this long-term key level here, long-term support area level range here, and that on a shorter term basis we have something of a bottoming out formation that you would look to monitor through here. So in terms of this structure, again on a short term basis, you want to look for something like that. And what we're essentially looking for here is some compression, combustion, whatever you want to call it, pressure building up in this downward wedge type formation that we see in play. So it's already started to break the shallower of the formation there. And so what we would look, in terms of monitoring the situation here, we look to see it can chop around a little bit in there and then look for a potentially strong move back up to the upside. And so if this was to begin to develop, we'd be looking at 1.24 as a fairly near-term target. Okay. Again, in terms of risk versus reward, depending on where you're able to be positioned and get in, the ideal, again, assuming this plays out, which is an if, of course, but assuming this plays out, the more ideal scenario is to get positioned along the lower end of the short-term uptrend line there. But even if you were to get it on the confirmation levels, or near the confirmation levels at around that 120 or so, with a 124 target or just below, you would end up with a fairly good risk to reward ratio there, even using fairly conservative figures and being reasonably generous with your stop loss distance. Okay. Canadian franc is next on the list. This one looks very messy, and it is, just because I've been looking at this one for a long time as part of this broader, this broad, very broad consolidation range there, but more shorter term, still a couple of years, mind you, a year, that is, no, a couple of years, looking for this general sort of sweeping formation to come through like so. So I don't have anything overly specific on this one because it's a bit messy, but essentially we'll be looking for some continued sideways action through here, but with more potential and certainly more risk reward to the upside. Okay. I could talk a little bit more about this one, but it's not really ideal. Dollar Canadian. So this is at a fairly key level at the moment, and it's something that should be watched for all interested in currencies and the dollar Canadian in particular, of course. But with that, this uptrend line that we see in play here should be taken as fairly significant. And if we were to see a breach of this, or even a strong break in particular, it would signal a lot more downside potential. Okay, so it's getting pretty close to make or break type levels, and it's an interesting one to watch. IU.au, there's a little bit bearish, and that's it. And so that's all we have on the market overviews for now. It's not a great deal to talk about with gold. The retracement that we've had over the past couple of weeks or so is healthy. It doesn't say much in terms of the long-term upside potential. In fact, it's really held its ground quite well given the strong run-up that it's had. We'll be looking for some strong consideration of a buying opportunity around this 1400 or the low 1400s. Similar situation, of course, with silver. Silver's looking a little bit more bearish. It's looking a little bit more confirmed to the downside, but again, on a longer term basis, still looking very, very promising. And we'll finish up on Bitcoin. Bitcoin is not looking very good. We look for, this is something of a bearish channel. Sorry, bearish flag. Yeah. Like so. So right now, naturally, as you can see here, the medium to longer term momentum is to the downside. In terms of looking for an entry to the downside, you would look at this formation here as a potential entry for that. Taking a shorter term perspective, you do have something of a head and shoulders type formation in play here, but don't be surprised if it needs a little bit more time to jump around and consolidate within this range here. In validation of this bearish notion is when you start to see these downtrend lines breached, the inner one here and the outer one there, which may well coincide with this sort of key level of 9,000 or so. Just be careful, as always with Bitcoin. There's a lot of terrible advice out there in all shapes and forms, and even the best advice in the world when it comes to Bitcoin can never be taken without a high degree of caution, because of the tendency for Bitcoin's underlying fundamentals to change very quickly. It has a lot of fundamental risk factors in play, everything from politics to regulatory to internal sector competition, and even external sector competition, now that we've got so many large corporations around the world continually putting resources into their own corporate cryptocurrency developments and their own proprietary technologies. Okay, so just be really careful with Bitcoin, even if you're generally careful in nature. So that's that one there. All right, so what we have now. So I want to take a bit of a look at some of the other things that are going on. So we're looking to launch some new services and get back into relaunch the VIP side of things, the more in-depth education and the signals analysis and recommendations side of the VIP service, now that markets are starting to present some more clarity and some more opportunities. And so I just wanted to give people a bit of a refresher and let people know what's going on with that, because there've been a few updates to the site. So we're on the members homepage, by the way. So IU.com.au/members. For those of you that are new or have recently joined, this is the key page. This is the one that you want to treat as your homepage, essentially. And with that, you've got your 4 main navigation boxes here. This is the focus updates session, which is where you're probably watching this at the moment. Then we have the VIP market sessions, which is like the focus updates, certainly in format, but it contains the VIP content. Then there's the IU Academy, which is also recently launched and has a bunch of lessons there, a couple of courses and a bunch of lessons continually being developed and added to at a pace of 2 or 3 a week or so. And then there's IU Connect, which is just how you can get general updates and stay abreast of upcoming education courses and live market updates and everything else. We've added this button here as we're now more active on social media, just as a more efficient way of keeping in contact with people. So if you come back to the site after a while, then you can just click this one and it'll bring up some of the recent updates that we post on Facebook, including new lessons. So the lessons are on IU Academy are running live. Some of them, not all of them, but a lot of them are running live, but they're primarily intended really for recordings. The lessons themselves go from anywhere from 15 minutes to sometimes up to an hour, but generally 15 to 20, 25 minutes or so, perhaps. But they're all there and they're all recorded in case you miss it. Now, we've also added this button here, which is very, very handy, because when you go into the IU Academy, you actually start by going to your profile page, like so, and then you can see the courses that are available to you. These are the couple that we have available right now, and you can see the content of the courses there, or your progress, I should say. And as you progress through any particular course, and everybody should start with the essential core concepts, by the way. It's a big mistake, and it's a big failing of the industry to jump to the end and start trying to teach people entry techniques and all the different ways in which market professionals and unprofessionals and gurus and everybody else go about trying to predict the future without imparting upon people a solid understanding of the foundational concepts. Okay, if you start with the foundational concepts, then you can gradually build your knowledge, your experience, your confidence level, and very importantly, you can start to develop your own style and preference and make a clearer and better educated decision as to which direction you want to go down in terms of whether you want to be a short-term trader, a long-term investor, or perhaps some combination thereof, and perhaps some combination of diversified strategies across different markets and asset types and so forth. But the whole purpose really of the Academy is to provide this to you in a structured way so you don't get lost, and so you can actually do things in proper sequence, in proper order, without bouncing around the place too much. So all your lessons are there, and some of them are due for release over the coming couple of weeks or so. But when you're jumping around from different pages and so forth, you can always just go to this button here, which will just take you straight back to the last lesson. It'll take you straight back to the last page in the IU Academy that you left off at. Okay. Then there's so in terms of live events, for those of you that just want to come along to the live events and perhaps aren't that interested in the structured side of things, there's this another button up here that just has the VIP sessions on the right and the focus sessions on the left, but that actually takes you to the exact same place as either of these. Okay, so it's just the same. It's just something that you can access from basically anywhere on the site. Now, with the courses, there's another course that's soon to be released, which is all about effectively trading the signals. It's not enough to just get recommendations thrown at you and sent to your email inbox. A lot of people don't know how to put them into play, and a lot of people don't know whether this is the kind of trading opportunity that's going to suit them and suit their risk profile. And very few people, in fact, actually know how to effectively put a recommendation or a signal into effect with proper risk management and taking the various things into consideration. So in conjunction with the Essential Core Concepts course, there's going to be a course that's dedicated to helping people understand the concepts that are required to effectively and professionally trade the signals that are going to be sent out to you as part of the VIP service. So with that, they look, just to give a bit of an overview there. So focus updates, which we're looking at now, are general updates, market overviews, and special and partner events. We're very selective with our partnerships, as a lot of you will know already, but we will be running partner events because this business of trading and investing is all about partnerships. No man is an island, as they say. And the VIP sessions is more of the specific analysis, including specific entries and exits, more of an actual recommendation than simply a setup or an overview or something to keep on your radar. It's actually more specific and exact and precise. Recommendations included thereof. And we're also going to be looking at some of the concepts surrounding the markets and surrounding the recommendations that we give in a lot more depth. Okay, so there's a difference between the two. The focus is just, we used to have different channels, but now we've just boiled it down to two to make it nice and easy. There's focus, which is your general one, and that's open to everybody, open to all members. Then there's the VIP sessions where things get a bit more serious and a bit more precise and specific once again, and this is only open to VIPs. Now, in saying that, they're actually going to be essentially in sync for the time being, because we've just really relaunched the VIP service and really getting back into things. So for now, the VIP service is actually open to everyone, and you'll see a lot of overlap between Focus and VIP, but over time they're going to become a lot more separate and distinct. And likewise with the Investor Unity Academy, the IU Academy, right now everything is open to everyone, but later on there's going to be some VIP only courses there. And just in terms of access, once again, if you want to note these down or save it to your favorites, again, it's there on the site. It's pretty easy to find, but IU.au/focus. For message updates, you should follow us on Facebook, or even better, get the Facebook messages sent to you. So that's just m.me/Investor Unity. And for other ways of staying updated, just go to IU.com.au/connect. The VIP session, there's IU.com.au/VIP members, or through the site, as I pointed out. And for VIP alerts, we use, or we're going to continue to use, I should say, the Telegram alerts. So Telegram is a very good little app that some of you already have some experience with. But for the VIP alerts, we're going to be sending that out via Telegram. And the other thing is that we're actually setting up a live signals server to work in conjunction with some of the new strategies that we're implementing, not just for the VIPs, but also for the managed services. I don't have a great deal of detail to share with you at that point on this one, because it still hasn't quite been released, but it's essentially an always on service that you can connect up to and see what's happening on the markets and on our radar, and get alerts in a very effective way. It's going to be very effective or very useful for managed clients that want a higher degree of transparency, and very useful for those that want to do short-term trading for themselves in conjunction with everything else. But we have more to come on that one. And so that's all I have for now. And so thanks for coming along. It's been an extended focus session. I hope I've made up for the delays in some way. VIP sessions are going to be running each Tuesday from now on, each Tuesday at 7:30. So the reason we do it on a Tuesday instead of a Monday is because we want the US session to come and the US market to come in and start its week. So we want to get up on Tuesday and see what's happened on the US Monday, and so that we can take that into consideration. And largely, of course, because there's going to be a much stronger focus upon equities for the VIP service. But that's it. Thanks for coming along, and bye for now.